Well, our top focus on Beyond Business Insights. US President Donald Trump has urged the Federal Reserve to cut interest rates as US tariffs begin to affect the economy. In a post on Truth Social, Trump argued that lower rates would benefit the US economy as tariff policies ease. His remarks diverge from the Fed's current stance, which is cautious amid inflationary pressures and global uncertainties. Fed Chair Jerome Powell pointed to heightened risks partly due to tariff-related inflation.
Say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation.
Since returning to office, President Trump has introduced new tariffs on key trading partners like China, Canada and Mexico, only to roll some back, creating market instability. Powell acknowledged that uncertainty is unusually elevated, complicating the Fed's efforts to balance inflation control with economic growth.
Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high.
The Fed has revised its economic predictions, cutting U.S. growth expectations to 1.7% in 2025, down from earlier estimates. Inflation remains a key concern, with the central bank now forecasting higher prices in 2025 and 2026, potentially delaying interest rate cuts. Meanwhile, the unemployment rate forecast has been revised slightly upward, signaling concerns about a potential slowdown. Despite this, the Fed is staying cautious, with Powell stating that recession risks have increased slightly but remain low for now.
Low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Financial markets have reacted positively to the Fed's cautious stance. This contrasts with the dipping consumer sentiment and rising prices, especially for essential goods. The on-again, off-again nature of trade measures has fueled fluctuations, leading to concerns that unpredictable policy shifts could further complicate the Fed's job. Data reveals that key items have seen a price surge before and after Trump's inauguration. This includes eggs, crude oil and precious metals. Agricultural crops like wheat have also seen a 12% rise, influenced by tariff policies. Experts warn that tariffs could push up inflation while slowing growth and investment as well, further creating a difficult environment for policymakers. The Fed's latest decision was not unanimous, with at least one official opposing a slowdown in balance sheet reduction. For now, the central bank remains in wait-and-watch mode, balancing inflation risks with the need to support the economy. And for more on this, we are now being joined by TV Mohandas Pai, Chairman, Arden Capital Partners. He's joining us live from Bengaluru. Welcome to Beyond Business Insights, Mr. Pai.
Thank you.
First up, what do you think about US Fed holding rates, and what does it mean for America's economy?
No, I think the US Fed should have reduced the rates for a very important reason. The housing rate reset is increasing. Housing loan rates are pretty high. And I think America's industry is getting hurt by high real interest rates. Despite inflation being quite low, the rates are very, very high, and they've been maintained for a long time. And the cost for the government of refinancing the rates is going to be very high if they keep it going for some more time. I think it's time for them to reduce it and take a chance. Powell is saying that the risk of tariff hikes is going to be high. We don't know what is going to happen. Yes, there'll be a little bit of dislocation due to tariff hikes. That is true. But oil prices are quite low, and the oil prices are fairly stable. The chance of oil price going up is not too high. And consumption is getting hurt in the United States because of high EMI and high interest rates. The interest rates are very high for an economy with that kind of inflation rate, which is quite low. I think they should have taken the risk and done it. I don't know whether politics is becoming more important for Powell, because Trump has been pushing for reduction of interest rates. But I think they should have done it and not waited long.